I bet you didn't know that value investing can uncover hidden gems in the stock market. In the world of finance, there are many different investment strategies. Value investing is about finding hidden gems that others have overlooked. It's a long-term strategy requiring patience, discipline, and a keen eye for opportunity. By understanding its principles, investors can make informed decisions and position themselves for financial success. Stay tuned to the end to find out what I consider my current favorite value investment. Bruce C. Greenwald, a renowned professor at Columbia Business School, is a leading voice in value investing. His approach emphasizes understanding businesses and their competitive advantages. Greenwald stresses the importance of margin of safety, buying stocks at a significant discount to their intrinsic value. His teachings help mitigate risk and protect investors from permanent capital loss. Greenwald's work has demystified value investing, making it accessible to both individual investors and institutions. Value investing is about buying assets for less than they are worth. It requires careful analysis and a long-term perspective. Value investors focus on understanding the underlying fundamentals of a business. They seek a margin of safety by buying stocks well below their intrinsic value. This long-term perspective allows them to ride out market fluctuations and benefit from the growth of undervalued companies. Imagine you're buying a used car. You'd check its condition, mileage, and compare it to similar cars. The same principle applies to investing. Intrinsic value is based on a company's ability to generate cash flow and profits over the long term. Value investors seek to buy the whole tree at a discount. Determining intrinsic value involves digging into financial statements and understanding the company's business model. Not all businesses are created equal. Some companies possess competitive advantages or moats that protect their profits from competition. These moats can be brand reputation, cost advantages, or unique technology. Identifying companies with durable competitive advantages is crucial for value investors. These companies are more likely to withstand economic downturns and deliver sustainable growth. Value investing stands out as a beacon of patience. It's a long-term approach that requires discipline and a willingness to wait for opportunities. Value investors understand that the market is not always efficient in the short term. Patience is about having conviction in your analysis and sticking to your strategy. This steadfastness allows value investors to weather market storms and emerge stronger. Imagine yourself at a flea market surrounded by trinkets and treasures. Value investors use various tools to uncover hidden gems in the stock market. They analyze financial statements, industry trends, and management teams. Common metrics include the price to earnings, PE ratio, and the price to book, PB ratio. These tools help identify undervalued companies with strong earnings potential. The margin of safety is a principle championed by Benjamin Graham. It acts like a buffer, protecting investors from potential losses by buying stocks at a significant discount to their intrinsic value. Value investors create a safety net. This conservative approach provides peace of mind and resilience in uncertain times. The wider the margin of safety, the lower the risk of permanent capital loss. Value investing is not without its pitfalls. One common mistake is mistaking cheapness for value. Value investors must distinguish between true value and value traps. Another pitfall is falling in love with a stock and holding on to it for sentimental reasons. Impatience can lead to missed opportunities and subpar returns. Value investing embraces the power of time as a patient ally. It's about the slow and steady accumulation of wealth over a prolonged time frame. This long-term perspective allows value investors to ride out market fluctuations. They understand that intrinsic value is dictated by the enduring strength of a business's fundamentals. This sense of ownership encourages thoughtful analysis and prudent decision-making. Section 2, diversification, spreading the net. Wisely, imagine a fisherman casting a net into the ocean. Would he throw all his hopes on a single fish? Unlikely. A wise fisherman casts a wide net, increasing his chances of catching a variety of fish and mitigating the risk of coming up empty-handed. Similarly, value investors understand the importance of diversification, spreading their investments across different companies, industries, and asset classes. Diversification is like building a sturdy bridge with multiple pillars. If one pillar weakens, the others provide support, preventing a catastrophic collapse. In investing, diversification acts as a buffer against unforeseen events that can impact a single company, industry, or even an entire country's economy. It's about not putting all your eggs in one basket, ensuring that a single unfortunate event doesn't wipe out your entire portfolio. This doesn't mean spreading your investments thinly across hundreds of stocks. Value investors are still selective, focusing on identifying undervalued companies with strong fundamentals. However, they recognize that even the most thorough analysis can miss certain risks or misjudge future prospects. Diversification helps to mitigate these uncertainties, creating a more resilient portfolio. The extent of diversification depends on an investor's risk tolerance, investment goals, and time horizon. A younger investor with a longer time horizon might opt for a more concentrated portfolio, focusing on high-growth companies. A more conservative investor nearing retirement might prefer a more diversified approach, spreading their investments across various asset classes, including stocks, bonds, and real estate. Section 3, tuning out the noise, staying focused amidst market volatility. Imagine yourself in a bustling marketplace surrounded by a cacophony of voices, vendors hawking their wares, musicians playing instruments, crowds chattering excitedly. Amidst this sensory overload, it's easy to get distracted and lose sight of your purpose. The stock market can feel like this bustling marketplace, overflowing with news, opinions, and speculation, all vying for your attention. Value investors understand the importance of tuning out this market noise and staying focused on their long-term strategy. They recognize that the constant barrage of information, from daily stock price movements to expert predictions, can be more distracting than helpful. It's like trying to navigate with a faulty compass. The constant fluctuations can lead you astray from your intended destination. Instead of being swayed by short-term market sentiment, value investors anchor their decisions in thorough research and a deep understanding of the businesses they invest in. They focus on the fundamentals, earnings growth, cash flow generation, competitive positioning, rather than the fleeting whims of the market. This disciplined approach helps them avoid emotional decision-making and stay the course during periods of market turbulence. This doesn't mean ignoring market information altogether. Value investors stay informed about economic trends, industry developments, and company-specific news. However, they filter this information through the lens of their long-term investment thesis, avoiding knee-jerk reactions to short-term events. They understand that the market often overreacts to news, both good and bad, creating opportunities for patient investors to capitalize on mispricings. Warren Buffett, the Oracle of Omaha. No discussion of value investing is complete without mentioning Warren Buffett. Buffett's name is synonymous with value investing, inspiring generations of investors. His journey from a young stock picker to leading Berkshire Hathaway showcases patience and long-term vision. Buffett's philosophy is rooted in the principles of his mentor, Benjamin Graham. He seeks companies with strong advantages and consistent earnings. Buffett holds investments for decades, leveraging the magic of compounding. His long-term investment in Coca-Cola exemplifies this approach. Geico, one of his celebrated investments, showcases his ability to identify undervalued companies. Buffett's success extends beyond picking stocks. He's built a company with a strong culture of value investing. Benjamin Graham, the father of value investing, laid the intellectual foundation for modern value investing. His seminal works, Security Analysis and The Intelligent Investor, are essential reading for understanding investing principles. Graham emphasized rigorous financial analysis, a margin of safety, and long-term returns. His approach was forged during the Great Depression, instilling a deep skepticism of market efficiency. He advocated for buying stocks like businesses, scrutinizing financials, and demanding a discount to intrinsic value. Graham's concept of Mr. Market illustrates the irrationality of short-term market movements. His teachings influenced generations, including Warren Buffett, emphasizing discipline, patience, and intrinsic value. Check out my video on The Intelligent Investor for a full breakdown of the book. Section 3, Seth Klarman, the disciplined value investor. Seth Klarman, a renowned value investor and founder of the Baupost Group, a highly successful investment firm, embodies the principles of disciplined value investing. Known for his patient approach, rigorous analysis, and unwavering focus on risk management, Klarman has consistently outperformed the market, even during periods of extreme volatility. His investment philosophy, outlined in his book, Margin of Safety, echoes the teachings of Benjamin Graham, emphasizing the importance of buying assets for less than their intrinsic value. Klarman is known for his willingness to hold cash, sometimes a significant portion of his portfolio, when he can't find attractive investment opportunities. He believes that patience is paramount in value investing, and he's not afraid to wait years for the right opportunity to arise. This disciplined approach has allowed him to capitalize on market dislocations, buying undervalued assets when others are panicking. One of Klarman's most notable investments was his purchase of discounted debt during the aftermath of the 2008 financial crisis. While many investors were fleeing to safety, Klarman recognized an opportunity to buy deeply undervalued assets from distressed sellers. This contrarian approach, driven by his focus on intrinsic value and margin of safety, generated substantial returns for his investors. Klarman's investment philosophy extends beyond simply buying cheap assets. He's a proponent of understanding the downside risk before making an investment, always seeking a margin of safety to protect against errors in judgment or unforeseen events. His emphasis on risk management, combined with his patient and disciplined approach, has made him one of the most successful value investors of his generation. The enduring relevance of value investing. In a world of high-frequency trading and algorithmic strategies, it's easy to wonder if value investing still holds relevance. The answer, unequivocally, is yes. Value investing remains a beacon of clarity and reason in a turbulent market. It provides a reliable compass for navigating financial complexities. Its allure lies in its simplicity. It focuses on intrinsic value, margin of safety, and long-term compounding. This approach resonates with logic and common sense. The market's irrationality creates opportunities for value investors. They patiently wait to deploy capital when opportunities arise. This disciplined approach allows them to weather market storms. The success of legends like Warren Buffett and Benjamin Graham testifies to this timeless approach. Practical advice for budding value investors. Embarking on the journey of value investing can feel like setting sail on a vast ocean, the horizon filled with both promise and uncertainty. For budding value investors eager to apply these time-tested principles, a few practical pieces of advice can serve as guiding stars, illuminating the path towards long-term investment success. Firstly, prioritize education and continuous learning. Value investing is not a passive pursuit, but an active endeavor that requires a deep understanding of financial statements, business models, and industry dynamics. Devour books, articles, and research reports, immersing yourself in the wisdom of successful value investors like Benjamin Graham, Warren Buffett, and Seth Klarman. Treat each investment decision as an opportunity to expand your knowledge and refine your analytical skills. Secondly, cultivate patience and discipline, two essential virtues for any value investor. The market will test your resolve, tempting you with short-term gains and instilling fear during periods of decline. Remember that value investing is a marathon, not a sprint. Stay focused on your long-term strategy, avoiding the urge to chase after fleeting trends or make impulsive decisions based on market noise. Thirdly, embrace the margin of safety as your constant companion. In the world of investing, uncertainty is inevitable. The margin of safety, the difference between the purchase price and your estimate of intrinsic value, acts as a buffer, protecting you from potential losses due to errors in judgment or unforeseen events. Treat it as a non-negotiable principle, demanding a significant discount to your estimate of intrinsic value before making an investment. Embarking on your value investing journey. The world of investing can seem daunting, a complex tapestry woven with threads of risk and reward. Value investing, with its emphasis on understanding businesses, analyzing financial statements, and taking a long-term perspective, offers a structured and disciplined approach to navigating this intricate landscape. It's a journey that requires patience, discipline, and a willingness to learn from both successes and setbacks. As you embark on your value investing journey, remember that you are not alone. A wealth of resources, from classic investment books to online communities, stands ready to guide you. Seek out mentors, learn from experienced investors, and engage in thoughtful discussions about companies and industries that pique your interest. Value investing is more than just a strategy for picking stocks. It's a philosophy for approaching financial decisions with a long-term perspective and a focus on intrinsic worth. It's about aligning your investments with your values, seeking out companies that you believe in, and participating in their growth over time. Embrace the journey, embrace the learning process, and remember that the greatest reward in value investing is not always measured in monetary gains, but in the satisfaction of making informed decisions, building a resilient portfolio, and achieving your financial goals with confidence and peace of mind. And as promised everyone, my favorite value investment is currently Alibaba. I will break down why in a later video. I am not a financial advisor, so please invest wisely and do your own research. If you enjoyed this video, please take a minute to like and subscribe. It helps the channel out tremendously and is completely free to do. Thank you, and catch you in the next video.